session. I know it's been a long day. Been a bit too ambitious with the program, but the idea was really to fit in as many different angles as possible around this topic, around exits, M&As, IPOs, and as you've heard, there's actually quite a lot of different perspectives that are all useful in their own way, from legal to banking to investors to entrepreneurs. So to wrap this up, we actually are lucky to have somebody who has a lot of experience like across the board with M&As, IPOs, PE, VC, everything. So that's maybe not everybody's familiar with you. So Brian Spar, CEO of Sparring Partners, is going to tell you more first in the introduction before we switch to an interview time about what you're doing and what you've seen. So this is the remote. Great.
Well, good afternoon. First of all, can everyone hear me?
The microphone is
Yes, no? Okay. Good afternoon, or I should almost say good evening. Almost time to go out for a drink. So let me give you a couple minute background on myself. I spent most of my career at Lehman Brothers. For those of you that are over 29, you may be familiar with that name. That's probably why I still wear French cuffs, which in those days always wore French cuffs, always white shirts, and obviously Ferragamo or Hermes size. I ended up living in London for 7 years, ran European capital markets. That is a business where we help companies raise capital. So probably do on average a few $1 billion a month in transactions. Then ran parts of capital markets for Lehman in New York. In 2000, decided to set up my own firm. We do two things. We exclusively, just going back, Lehman obviously dealt with public companies and then some private companies. And the private companies would be the larger ones. The Cargills, the Mars, the rich people like that. And mainly IPOs, a lot of them. At Sparring Partners, we exclusively focus on private companies, and we do three things for them. I can just point out, we help them raise.
That's a pretty good point. So you should press the thing.
Oh, good.
That's interesting situation.
Oops.
Keep pressing.
We help them raise equity capital. If they're big enough, we help them raise debt capital, and then we help them sell the business or explore strategic options. That is one side of the business. On the other side of the business, and this is where we're very unique for a small firm, we are very much on the inside of VC, growth equity funds, and PE funds. In other words, we work with a lot of funds and help them raise their next funds. Why? We obviously, having been on the street, a number of my colleagues have been on the street, we basically know every institutional investor in the world, or certainly the US and Western Europe, that has over a few $1 billion. And they all sort of allocate 15 or 20% to PE. So that's our basic business, exclusively tech companies on the M&A and financing side. And then on a fundraising side, I'd probably say 3/4 of our clients are focused on tech. So we really get to see sort of exactly what's going on the inside, which is very helpful. What's interesting, and to me what's very, very confusing out there, and you heard a lot of panel members over the couple of sessions I was able to make today talk about Series A, Series B, Series D, or whatever it happens to be. I think most of that is relatively irrelevant to the investor, and it's irrelevant to the acquirer. No one really looks at the capital side of the business, the liability side. What they focus on is how is the business doing? Does it have revenue? Does it have customers? What is the growth rate? What is the retention rate if it's a software company? If it's a consumer company, what's its customer acquisition cost versus a lifetime value? And it's really up to the board and the shareholders to really determine, okay, well, at that price that we're offered by the outside world, whether to provide more financing capital or to acquire the company. It's really among those three, Jeremy from Bessemer and other people, to really figure out how to cut the pie. But you as an entrepreneur really have to focus on growing the business, making it happen, and then you'll have plenty of options down the road. Can I just ask, and maybe someone else asked you previously, can I ask how many of you are sort of at companies, whether CEOs, founders? And then how many of you are investors? Okay. So I think if you think about it, once again, if you're the CEO, you got to be focused every day on winning business, hopefully at a decent price, growing the business, retaining those clients, and getting more business. I think worrying about IPO, worrying about a lot of these other things are much longer term issues, and I really wouldn't worry about it. As far as customers go, what's really critical, and I think there's much more in here, it's kind of talks about us. You really got to think about then, if you are going to raise money or are going to consider selling the company, you really got to go through a process. And as we mentioned before, you really want to be ready. So whether and if you think about the data room, that's really having all the pieces to the puzzle. So if you think about, let's see if I can do this right again. Think about just collecting all the information. Talk about the overview of the company, product highlights, competitive landscape, financials, case study, team, growth strategy. Go to market. And this sort of refers to, do you really go out and have your own sales force? And you individually go out and try to win Facebook or try to win Oracle or try to win Costco as a client? Or are you using a channel partner? So someone like an Accenture or some channel partner out there where they're going to be offering your product. And the reason why they're offering your product, they want to do the integration of that product. And this is really more focused, at least initially, on the enterprise side. Can I just ask those people who were CEOs, founders, how many of them are enterprise-focused companies? And how many of them are consumer-focused? Which is what I guess the majority. Okay. So one of the key things is how do you get more clients? And just sort of looking at all these KPIs are really critical. So if you go into financials, people really want to look at unit economics. So if you really do get a customer, they're paying. Are they paying monthly? Are they paying quarterly? Do they pay you a year up front or 2 years up front? To understanding your own business unit economics is very critical. Because people are going to ask you a lot of questions. And whether it's a VC, a family office, as more and more of them are getting very focused on hiring talent from other places, or a corporate acquirer, or for that matter, a strategic partner. They really want to make sure you know your numbers, and you don't want to be blindsided by a question where you don't know some of the basics about your own business. Then sort of thinking about, who to go after. So if you think about who you want to raise money from, or who you want to sell the business to, you don't want to go to a life sciences fund, if you are a venture fund, if indeed you're a consumer or an enterprise software company. So you really want to make sure, and I think it's a British term, it's sort of horses for courses. So therefore, you really want to think about, you want to know as much as you possibly can about the party you want to go speak to, and whether it's on, once again, the VC side or the strategic side, you really have to know who the other party is, both as an institutional organization, but also who that individual is who you're speaking to on the other side. Then you want to put all this material together and really try to role play. And you want to get someone who's hopefully thoughtful and has gone through it a number of times on the other side so that they can really drill you with the sort of questions you're going to get. And it's kind of like the first time you meet anyone, whether it's on a date, whether it's on a VC or meeting or whatever. First impressions are generally lasting impressions. That first 15 minutes to 25 minutes where you're either going to get their attention or you're not. And it's not like, I doubt anyone here already owns 50 McDonald's. In that case, 5 McDonald's. No one really cares about who the general manager is. In that case, you're just going to look at all the metrics of the business. In this case, you really care about who the leadership is, what your direction is, and what some of those initial steps that you've taken. If you think about conducting the outreach, you got to think about what's the best way to do it. Should you do it directly? Do you have a board member? Is there someone else? Should you go hire a friendly banker who has a lot of experience in life science, consumer internet, enterprise software, whatever it is? There's something to be said by having a third party make that introduction. Why? You're going to have a lot more credibility than you might as someone they don't know. And as an entrepreneur or a CEO, what should you be doing 24/7? You should be focused on your business. And just like you hire a lawyer to help you put together all the docs, same thing. You should really be focused on building your business, focused on the business, thinking about what trade shows you should attend, what events you should go to try to really try to scale your business. When you have those conference calls and meetings scheduled, you got to really prepare. You want to have a PowerPoint presentation in front of them. You want to be able to hit the key points. You want to go through their, certainly Google them, but go through all the press releases of this corporation. What sort of press releases have they made? What's the business unit you think is the most logical fit for your company? Try to understand who the head of that is. What sort of partnerships have they done? What other companies have they acquired, etc. Same thing. If you're going to talk to a VC or a private equity firm, and let's say you're doing cybersecurity, they already have 3 cybersecurity companies, but one of them is already an endpoint solution, and you're an endpoint solution company. They probably don't want to talk to you. There's going to be a conflict, or they're going to try to suck a lot of information from you, and you really won't be comfortable when you realize, oh my God, I just gave someone who's a big shareholder and one of my competitors too much information. So you really got to think about who you speak with. And then to some extent, if they really are interested, so going back up here, you should be able to give them an executive summary without an NDA, without any confidentiality agreement. But if they're interested, you want to allow them to dig in. And as expressed on the previous panel, having a data room available is critical because that's where you have all the information on the company. And having a well-organized data room is very helpful. Number one, when they go in, you're going to have, assuming everyone uses a lawyer here, there's going to be an NDA. They won't be able to access the data room without clicking yes, I accept the terms of the NDA, which includes not only information about your company, but what's very, very important is a non-poach. So you're going to learn, if they're going to dig in, they're going to learn about not just the CEO and the CFO, but who's the CTO, who's the head of the go-to-market strategy, who's the head of marketing. You certainly don't want someone who you're talking to realizing, oh my God, you got a great talented person. I can see on LinkedIn that he's a person that we wouldn't mind to hire and to reach out to. You want to make sure in your NDA there's a non-poach, which means during that term, and usually lasting another year or two, they're not allowed to directly poach one of your employees.
Maybe just as a kind of quick question, sorry to interrupt there, but isn't that something that Google was kind of notorious for, like to basically talk to a bunch of AI or other companies?
So the way to get around that, once again, maybe Eli or one of the lawyers can address this, but in a non-poach, the way they're able to poach, they go hire Russell Reynolds and Korn Ferry and say, these are the 20 sort of companies I want to target to see if they have employees. So the way they can sort of get around it is by saying because of a general solicitation or a general notice through a third-party headhunter, they talk to one of your employees. I don't know the specifics of the Uber case at all. So going to the third column, which maybe just going here to the last thing. For if someone does get interested, they're going to have a lot of questions. Number one, you should be prepared for probably 90% of those questions. So because you already had a number of meetings with a VC or a corporate, they're going to have a lot of questions. You should probably know 90% of those before you even go in. You should be prepared with those, hopefully have most of that information in the data room, so that if they do ask it, you can say, well, gee, it's already in folder 3 and section C, and hopefully they'll understand that you've already heard the question before, you're well prepared. For those questions you get, by the way, that you're not prepared to answer, never ever flub it. Why? Because they're going to catch you, and it's going to impact your credibility with them dramatically. Just say, gee, that's a great question. Let me get back to you. Never ever try to pull something over on someone, because keep in mind, there are probably going to be a couple people in the room. Someone's in there taking very copious notes, and you don't want someone to come back to you when you're sort of rounding third base, hoping to close, when all of a sudden they said, well, gee, that meeting 3 weeks ago, you said the following. What happens on negotiations, and this is just very, very important, our experience. So we probably closed, my career on Wall Street closed thousands of transactions. Sparring partners would probably close 5 to 10, 15 deals a year. It's never you that wants a term. It's never the lawyer that wants a term. It's never us as a banker who wants a term. Why? If I say, well, gee, I want this, or if this company CEO says, well, gee, I want this, guess what? The VC or the corporation who's going to acquire you, may acquire you, is going to say, tough luck. It doesn't get up their competitive juices. What really makes them sharpen their pencil is you say, well, gee, party A and party B, who's going to invest or acquire the company, they're very happy to give that term. But when you say that, it's normal competitive juices. They're going to say, oh, of course I can raise my price. Or of course I can change my working capital adjustment. Or of course I can offer that indemnification. So just be aware, it's because of the competitive environment of the potential investors or the potential acquirers, which is going to allow you to negotiate the best terms. That has been our experience, and I would say 98% of the time, they always roll over and say fine. Why? Just stepping back. If someone's decided to invest in your company, or if someone decided to buy your company, that means that they're already a believer. They've drunk the Kool-Aid. They really believe that your solution is something that's strategic to them, or they believe that making an investment in your company is going to allow them to make their 3 to 10x, or whatever their bogey happens to be. So just be aware that you really want to get them excited and multiple hooks into them, where they really want to do it, and then they're going to become a lot more malleable when you negotiate all the terms and conditions. Going to the point on the panel, this is a time, before you sign away exclusivity, this is a time when you have the maximum capability to negotiate all those sorts of terms you want to. So what we generally do, and it's a little bit different on the sell side versus a financing, but on a sell side, the majority of the time, we already have for those people who get to that stage, where they say they're going to give an offer, etc. You want them to give an offer. You want to be able to discuss it with them, understand all the terms and conditions. We obviously then review it with the CEO and the board. What we want to do, if you do have them on the hook, they want to buy it, great. Besides price, which is only one component, we always have in the data room where they have to review it, is a draft of a stock purchase agreement, that final document. And there's 4 or 5 key sections in there. Number 1 is indemnifications. We heard that earlier. And absolutely correct. The money that you've been given, you never want to have it disgorged from you unless it's been fraud or fundamental refs are not true. Number 2, so indemnifications, reps and warranties, escrow. I would say most of the deals we've done in the past 2 or 3 years, none of them have more than 10% escrow. Why? Because if someone really wants it, they will have done enough due diligence where the amount of money they have to hold back is relatively little. Because they've done all the work, they don't think there's any unknowns, and therefore 10% escrow is a norm in today's market. We've actually done deals less than that. But what's also critical is how long do they hold it back? Is it for a year? Is it for 6 months? We've done some deals where it's 18 months, but half of it's released after 9 or 12 months. So if it's 10% holdback, 5% is released after 9 months or so, and then the other 5% is given back to you after that 18-month period. The one other one which is very critical and really wasn't mentioned at the lawyer panel before is working capital adjustment. So everyone's sitting there with a balance sheet. You have certain assets, obviously cash, account receivable. Well, no one here probably has inventory. And those are probably the 3 big categories. But on the liability side, you obviously have payables. And particularly in the software world or in the consumer world, you have something called deferred revenue. If someone's buying your software and they paid you $1,200 for an annual subscription to software, and they're only in the first month of that software contract, or you as an individual just subscribe to whatever you subscribe to, and let's say you paid $120 for that, so $10 a month. You want to use the first month. So on the liability side, you're sitting with all that deferred revenue. That is a liability item. And we spend enormous amounts of time negotiating working capital adjustments. And I would say one of the biggest items these days is deferred revenue. Taxes is another big issue, deferred taxes. And all of these things can amount to millions, if not tens of millions of dollars on a transaction. So negotiating all these terms are just critical. And I would say during that period of time, that gives us the best option to go back to all the other parties that were interested, whether VC investors or strategic acquirers, and say to them, gee, we have offers on the table. The board's meeting in 2 weeks' time. You pick something where you give them, or maybe 10 days' time. The board's going to be meeting to review this in 10 days' time. Now, keep in mind, it could just be Jeremy and the two other people, and they talk all the time. So you try to make it seem like it's a big deal at the board meeting, but it gives you time then to go back to all the other potential parties and say to them, gee, we have offers on the table. The board's going to be meeting in 10 days. Where are you in your process? What information do you need? And it's very interesting. When people know that something's going to happen, things generally accelerate pretty dramatically. So the process then about selecting the acquirer and the investor, there's a lot of things that go into that. How much of the equity do you own? Where do the investors stand? Have they been a long time? Do they want to get out? Do they have the ability to force it because they control the company, as a PE fund does, not as a VC fund? Usually they don't control a company. There's a lot of components which go into trying to decide which party to go to and not. I'll give you one good example. We did a trade where the terms become very important. We had a transaction where we represented a company in Bangkok. It was basically the hotels.com of Southeast Asia, called Agoda. They had offers where they could have gotten more money at close, but not a very good earnout, or they could have gotten decent money at close, but an earnout subsequently. They ended up selecting the latter, and they probably got 4 to 5 times the amount on a 2.5-year earnout than they did on the initial wire transfer. So trying to analyze and give probability weighting to what you think the business will do during those forthcoming years is very, very important. One other thing I just talk about with respect to due diligence and timing. A lot of your ability to negotiate is a function of how eager they are to do it and what's going on in the outside world. The outside world now is very, very sunny. Sentiment levels are high, confidence levels are high. A lot of funds have raised new funds, and generally bigger funds. And guess what? Probably most of the tech-enabled companies are trading at 90 to 100% of their all-time highs. It's really in the biotech world. For those of you that are in life sciences, the number of life science IPOs has been astounding over the past couple of quarters. I know next week's going to be another very big week for the IPO market. So, just be aware, bulls and bears do fine, pigs get slaughtered. It's an expression from my public days on Wall Street. So, go to the comments of Jeremy and the others. There could be a lot of people that, want to buy your business for $50 million or $25 million or $125 million. It's a lot of FU money, and people really have to look themselves in the mirror before they turn down an offer where you're going to get a financing. And I would say your business could be twice the size next year than it is this year. But if the public markets are down 15% and the world's wobbly, and who knows what happens in, the U.S. administration and other global administrations, trade wars, etc., you could end up getting a much lower price for your company next year in 2 different ways. Number one, the number of people that want to submit a bid could be maybe only 1 or 2 parties as opposed to half a dozen. And number 2, they're just going to look at public multiples. They're going to look at, there's a lot of other companies out there that are for sale. There's going to be a harder financing market. So just be aware if you are thinking about an opportunity, you really got to think about it. And I'd certainly consult with your banker, a lawyer, or someone to really think about what's right and what isn't right. And understanding your own personal position. There's a lot to be said for someone getting their first X millions of dollars in, because most people are in it for the passion, the excitement, and want to do something again. So nothing wrong with doing something again. We sold a company here in New York back in 2007, $80 million. No outside investor. It was ecstatic. Paid his taxes, probably had about $55 million after that. He had a 5-year non-compete. So even though he was supposed to stay with the company for a year, he basically just had to give his cell phone number and basically went off and enjoyed life for 5 years. After the 5-year non-compete, he just went back again and raised money. We helped him raise money, and he's doing the exact same thing again after his expiration of his non-compete. So, one of the things which the lawyer said, Eli and the other ones, you really want to make sure you get a lawyer who's done it before. Hey, I have a lot of friends who are lawyers. They may be great on IPOs. They're not good at doing a $10 or $50 million M&A deal or a financing deal. So you really want to be able to pick someone who really has a lot of experience in your category. Once again, life sciences, consumer internet, or whatever it happens. So there's a big difference, and you heard some of it before, between M&A and a financing. The way that everyone should look at a financing, it really is a mortgage on your business. If someone's going to give you $5 million or $30 million or whatever the amount happens to be, generally speaking, and as you heard all the VCs say, they generally don't buy common equity. They come in at preferred. It won't be participating preferred, won't have a liquidation preference. But that means when you do sell the company, that preferred gets paid off first. So they have priority, just like a mortgage might on your house or on your apartment. And after that, there's a waterfall. So you really got to think about, do you want to raise that additional money and try to grow the business with a enterprise value? And I'd say most investors like 25 to 35% returns. So that's sort of what they're computing in their own mind they're going to get from their VC or growth equity investment. So you really got to decide, do you really want to go take that $5 million or that $15 million or that $35 million? You're going to have a mortgage, which is going to give you a long runway to build the business, but there's going to be a lot of anxiety, as you heard them talk about, an entrepreneur is going to have during that period, because you're really going to have to go out there and consistently hit singles and doubles and really grow that business and worry about competitive threat, worry about turnover of staff, worry about all those sorts of things you need to worry about. So I just walked through a couple of different things, which I thought was important. Valuation. Keep in mind, the reason why a company is going to buy you is you're strategic. That's why they call them strategic. It really fits. You're really in the same category. They like the customer set. They like maybe the patents you have, a host of different things. A financial investor, it's kind of like you or I probably buying a stock. By the way, I basically don't buy stocks. I do ETFs. But if we're buying a stock, you probably don't care whether you buy Costco, Amazon, or REIT. You just want it to double by this time next year, or whatever your objective is. Same thing is true with every VC, growth equity fund, and PE fund. They may specialize in categories. They're going to specialize in software. They're going to specialize in consumer internet. They're going to specialize in manufacturing or specialize in life sciences. But basically, they're going to compare you to the 150 other companies you're looking at that quarter alone and figure out which one is really the best. While it's strategic, they're going to be, and by the way, if you look at the metrics, when we do transactions, I would say most of the VCs and growth equity firms are within a certain range. Why? Because once again, they all have the same return objectives for their institutional investors or their LPs. And they're all looking pretty much at the same stuff. They may have a slightly different playbook. They may have an opportunity to merge you with someone. They may have, different sort of view on your industry. But they're going to be much tighter band of where the offers are. The strategic is very different. They're going to look at you and think, wow, I can take out one of my competitors. Or this is great, I can move into a category I'm not in, but one of my competitors is in. So on a valuation basis, generally speaking, we see a corporation being willing to put a higher valuation on a company than a PE fund. And by the way, I put into that category of M&A also platform companies of PE funds. So a lot of firms like Vista, Thoma Bravo, Advent, Insight, a lot of these firms have tech-enabled companies, And what are they doing? They're doing a lot of add-ons to their companies. So I would definitely consider those strategics as well. Structure, obviously if you're being acquired, you're getting that money being wired to you, hopefully within 30 days. And there's a holdback of maybe 10% max on the escrow. Capital raise. We've definitely done some capital raise where the founders have been able to sell some of their shares. So maybe take a couple $1 million themselves. But by and large, you've just committed yourself to another 2.5 to 5 years to continue building that business. And I would say, a lot of times we see entrepreneurs where they raise the money, they can build the company up to a couple $1 million, or maybe even 10 or $20 million, but then it gets to a size where, number one, they feel they don't have the skill set or experience set to take it from 20 million to 40 million. Number two, the board's going to say to them, guess what? We don't think you have the skill set or the capabilities to do it, and we're going to push you out. And we have seen that countless times over the past couple of years. If you think about why someone invests in a company, as I said before, I think I may have said before, no one invests in a company for what it did yesterday, what it's doing today. They really focus on what is the company going to do in the future. So if you think about what are the company's growth prospects, that's what's really critical. How is it going to grow? How easily is it going to grow? How much more capital might you need in future financing rounds to be able to hit your objectives? I already discussed liquidity, and then personnel. I would say generally, if you sell an M&A, we always negotiate. Now, most of our clients, we've never done anything 4 or 5 years. That's kind of crazy. I can't believe they had to do that. Generally speaking, most of our deals are 1 year, where the CEO, maybe other members of the management team, happen to sign on for a year. And then as far as if you take money, you basically signed a non-compete for a period of time. You've obviously signed up to work for that company for the next 3 to 5 years, unless they fire you. So there's a lot of components which make it different between a financing and an M&A transaction. Some of this is repetitive, but I would just say what's critical here is strategics are really, really important. And I think when they were talking about, I think it was Jeremy from Bessemer, I think getting to know the corporations in your ecosystem, where maybe they can be a channel partner, maybe eventually they're going to be an acquirer, maybe